With unemployment still elevated and inflation projected to run below the committee's longer-run objective, the committee is continuing its highly accommodative policies. As you know, in normal times, the committee eases monetary policy by lowering its target for the short-term policy interest rate, the federal funds rate. However, the target range for the federal funds rate, currently at 0 to 1/4%, cannot be lowered meaningfully further. Accordingly, the committee has been providing policy support to the economy through two complementary methods: by purchasing and holding Treasury securities and agency mortgage-backed securities, and by communicating the committee's plans for setting the federal funds rate target over the medium term. I'll discuss these tools in turn, beginning with our program of asset purchases. In September 2012, the FOMC initiated a program of purchasing $40 billion per month in agency mortgage-backed securities, in addition to the $45 billion per month in longer-term Treasury securities that we were already acquiring as part of our maturity extension program. We stated that, subject to our ongoing assessment of the efficacy and costs of the program, purchases would continue until we saw a substantial improvement in the outlook for the labor market in a context of price stability. In December 2012, we announced that we would continue to purchase $45 billion per month in longer-term Treasuries after the maturity extension program ended later that month. Thus, our total purchases of longer-term securities were maintained at $85 billion per month,
and Ben
in addition to the reinvestment.
Giving us the explanation as to why the U.S. Federal Reserve is sticking with its current stimulus policy, basically saying, awaiting conclusive evidence that the U.S. economy, that its recovery.
Cumulative progress, the FOMC concluded at our June meeting that the criterion of substantial improvement in the outlook for the labor market might well be met over the subsequent year or so. Accordingly, the committee sought to provide more guidance on how the pace of purchases might be adjusted over time. The committee anticipated in June that, subject to certain conditions, it might be appropriate to begin to moderate the pace of purchases later this year, continuing to reduce the pace of purchases in measured steps through the first half of next year and ending purchases around mid-year 2014. However, we also made clear at that time that adjustments to the pace of purchases would depend importantly on the evolution of the economic outlook, in particular on the receipt of evidence supporting the committee's expectation that gains in the labor market will be sustained and that inflation is moving back towards its 2% objective over time. At the meeting concluded earlier today, the sense of the committee was that the broad contours of the medium-term economic outlook, including economic growth sufficient to support ongoing gains in the labor market and inflation moving towards its objective, were close to the views it held in June. But in evaluating whether a modest reduction in the pace of asset purchases would be appropriate at this meeting, however, the committee concluded that the economic data do not yet provide sufficient confirmation of its baseline outlook to warrant such a reduction. Moreover, the committee has some concern that the rapid tightening of financial conditions in recent months could have the effect of slowing growth, as I noted earlier, a concern that would be exacerbated if conditions tightened further. Finally, the extent of the effects of restrictive fiscal policies remain unclear, and upcoming fiscal debates may involve additional risks to financial markets and to the broader economy. In light of these uncertainties, the committee decided to await more evidence that the recovery's progress will be sustained before adjusting the pace of asset purchases. The committee will, of course, continue to monitor economic and financial developments closely. As noted in today's statement, in judging when to moderate the pace of asset purchases, the committee will, at its coming meetings, assess whether incoming information continues to support the committee's expectation of ongoing improvement in labor market conditions and inflation moving back towards its longer-run objective. However, as we have said, and as today's decision underscores, asset purchases are not on a preset course. The committee's decisions about their pace will remain contingent on the economic outlook and on the committee's ongoing assessment of the likely efficacy and costs of the program. Let me turn now to the FOMC's forward guidance regarding the federal funds rate. The committee again reaffirmed its expectation that the current exceptionally low range for the funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%, so long as inflation and inflation expectations remain well behaved as described in our statement. As I've noted frequently, economic conditions we have set out as preceding any future rate increase are thresholds, not triggers. For example, a decline in the unemployment rate to 6.5% would not lead automatically to an increase in the federal funds rate target, but would instead indicate only that it had become appropriate for the committee to consider whether the broader economic outlook justified such an increase. The committee would be unlikely to increase rates if inflation were projected to remain below our 2% objective for some time, for example. And in making its assessment, the committee would also take into account additional measures of labor market conditions, such as job gains. Thus, the first increases in short-term rates might not occur until the unemployment rate is considerably below 6.5%. The projections of the path of the federal funds rate by individual committee participants are generally consistent with this guidance. Although the central tendency of the projected unemployment rate for the fourth quarter of next year encompasses 6.5%, 12 of the 17 participants expect the first rate increase to take place in 2015, and 2 expect it to occur in 2016. Most participants also see the funds rate target rising only very slowly after the process of removing policy accommodation begins. The median projected funds rate for the end of 2015 is 1%. And notably, although the central tendencies of the projections for both inflation and the unemployment rate in 2016 are close to the longer-run normal values for those variables, the median projection for the federal funds rate at the end of 2016 is 2%, well below the longer-run normal value for the federal funds rate of 4% or so projected by most participants. Committee participants generally believe that because the headwinds to recovery will abate only gradually, achieving and maintaining maximum employment and price stability will require a patient policy approach that involves keeping the target for the federal funds rate below its longer-run normal value for some time. Let me close by noting that although the FOMC is employing 2 instruments of policy, asset purchases and forward guidance about short-term interest rates, the overall stance of monetary policy is what matters for growth, jobs, and inflation. Our program of asset purchases was set up a year ago to help achieve a substantial improvement in the outlook for the labor market in the context of price stability relative to conditions when the program was initiated, and we have made progress toward meeting that criterion. However, even after asset purchases are wound down, which we will do in a manner that is both deliberate and dependent on the incoming economic data, the Federal Reserve's rates guidance and its ongoing holdings of securities will ensure that monetary policy remains highly accommodative, consistent with an aggressive pursuit of our mandated objectives of maximum employment and price stability. Thank you, and I'd be glad to take your questions.
Chairman, Donna Borak with American Banker. The Financial Stability Oversight Council has already designated 2 non-bank firms as SIFIs, as you know, and potentially a third very soon, and presumably others to follow. However, little has been said in terms of how specifically these firms will be regulated by the Fed, which has been a chief criticism of the entire process. Given that, can you provide us any guidance at this point in terms of how far along the Fed is in terms of letting the banks know how they will be regulated besides tailoring the plans?
Well, the 2 firms that have been designated, AIG and GE Capital, actually have been regulated by the Fed because both of them are savings and loan thrift holding companies. So we have a lot of already experience with those firms and a lot of contact with those firms. We will, I want to use the word tailored because we want to design a regime that is appropriate for the business model of the particular firm. But our other objective, and what makes designation by the FSOC particularly noteworthy, is that the primary goal of the consolidated supervision by the Fed is to make sure that the firm doesn't in any way endanger the stability of the broad financial system. So we'll be looking at not just the usual safety and soundness type matters or supervision, which both can be, again, tailored to the types of assets and liabilities that the firm has. But also, we're going to want to focus on things like resolution authority, practices relating to derivatives and other exposures, interconnectedness, et cetera, to make sure that the firm in its structure and in its operations doesn't pose a threat to the wider system. And that's what is going to be distinctive about our oversight, not only of these designated firms, but also of the large bank holding companies that we already oversee and which we are already subjecting to tougher supervision, higher capital, stress tests, and all the rest.
LA Times, as you may know, the Census Bureau reported yesterday that the poverty rate and the median household income saw no improvement last year. And I wonder when you see median incomes turning up significantly for most people, and in light of the fact that people in the middle and the bottom have seen very little of the gains relative to higher income households, how would you assess the both quantitative easing and Fed policies?
Sure. So that's certainly the case that there are too many people in poverty. There are a lot of complex issues involved. There are complex measurement issues. I would just have to mention that. There are a lot of issues that are really long-term issues as well. For example, it might seem a puzzle that the U.S. economy gets richer and richer, and yet there are more poor people. And the explanation, of course, is that our economy is becoming more unequal. The more very rich people and more people in the lower half who are not doing well. There's a lot of reasons behind this trend, which has been going on for decades, and economists disagree about the relative importance of things like technology and international trade and unionization and other factors that have contributed to that. But I guess my first point is that these long-run trends, it's important to address these trends, but the Federal Reserve doesn't really have the tools to address these long-run distributional trends. They can only be addressed really by Congress and by the administration, and it's up to them, I think, to take those steps. The Federal Reserve we are doing our part to help the median family, the median American, because one of our principal goals, we have two principal goals. One is maximum employment, jobs. And the best way to help families is to create employment opportunities. We're still not satisfied, obviously, with where the labor market, the job market is. We'll continue to try to provide support for that. And then the other goal is price stability, low inflation, which of course also helps make the economy work better for people in the middle and the lower parts of the distribution. So we use the tools that we have. It would be better to have a mix of tools at work, not just monetary policy, but fiscal policy and other policies as well. But the Federal Reserve, we only have a certain set of tools, and those are the ones that we use. Again, our objectives of creating jobs and maintaining price stability, I think, are quite consistent with helping the average American. But there's a limit to what we can do about long-run trends, and I think those are very important issues that Congress and the administration, need to look at and decide, what needs to be done there.